I'm Guillaume Lambert. I'm the founder of Panoptic. I was actually in academia before. I have a PhD in physics. Assistant professor, tenure track, decided to live it all out 2 years ago to go and found a crypto startup. We do options on EVM and Ethereum. We're integrated with Uniswap. And then I'm going to go over the basics of how we see options, how we see options work on chain, and how Panoptic kind of ties it all together. We'll do a show of hands, I guess, in the morning also to stretch a little bit this early. Who here has used Uniswap themselves? And who here has been an LP in Uniswap? Few people. Are you still LPing now, or it's done and over? If you're still LPing, keep your hand up, or if you haven't done it in a while. Okay, perfect. So the key point is that Uniswap allows you to swap tokens. It's a New York Stock Exchange type. You just say, I want to buy so many tokens. It goes to you quite simply. It always works. There's a slippage, but overall, it always works. There's a role that's in the back end, which is a liquidity provider that takes on some risk, makes that trade happen. They kind of use when you swap, you use that liquidity provider's capital to make that swap happen. And you pay a fee that goes to these liquidity providers. So they get a compensation. And economists here, you probably see some trade-offs, but the LP side is quite difficult to manage, quite difficult to be successful as a retail user. You need some sophistication. And what we've discovered, or at least the thesis behind what we do, is that the LP side of Uniswap is actually an options clearinghouse. So we're able to connect swapping that happens on the front end of Uniswap with something that looks a lot like options in the back end for maybe the more sophisticated users that are LPs or LPing in Uniswap. I'll go over this. I liked yesterday's dynamic about people asking questions. So if there's any question, don't hesitate to raise your hand and ask. I'll go over maybe the life history of a trade on Panoptic as it pertains to LP positions on Uniswap. And again, the Uniswap, for those that may not have any idea, sorry about that, it's a different way of trading. There's no order book, there's no market maker, it's peer to protocol. You just interact with a smart contract to get your funds and swaps. It scales much better. The Trump coin was launched on an AMM like Uniswap. You can launch any token you want. No need to hire a market maker to create markets for you. So this is kind of what we do with options is just similar in terms of anyone can launch an options protocol, an options market. All right. Back to basics. Uniswap V2 is what was launched almost 6 years ago. At the core of Uniswap is X times Y equals K, or in my case, I write it as L squared. This is how the AMM works. This is an invariant. That formula has to be true before a trade, after a trade, during a trade. The whole thing has to rely on this being true and verified at all steps of the way. And this is what, there's even NFTs that kind of popularize this X, Y equals K. You can also plot this in a XY plane. You have a X and Y plane. You have a constant, if you want, that satisfies this invariant. You may have seen this as well. If you trade, you kind of have to stay along that curve. And the amount of slope of that curve is the price. It's quite visual. It's what you see conventionally when you get introduced to AMMs like Uniswap. You can also flip this a little bit and look at the value of your LP position, which is how do you transfer the invariant X times Y equals L squared to something that looks like a value over price. So you take the price, which is that slope, you do a transformation, you have a value as well. And if you go through the math of how much token X do I have in my wallet, how much token Y do I have, and the price comes into play, you get this square root, 2L square root of P. So if you hold an LP token in Uniswap V2 and the price goes up, it's a square root relationship. Holding a stock is a straight line. Holding a future is a straight line with leverage, so the slope is higher. Here you have some convexity. You have this square root term that exists when you hold an LP token in Uniswap. And this is what when I'm LPing, this is what I'm worrying about. This is what I consider. How much money do I have now? And if the price goes up, how much money do I make? Or if it goes down, how much money do I lose? I just keep that line as the value of the instrument that I'm trading. And these two is kind of maybe two dual representations of the same thing. You have X times Y equals K. You have the square root of the value. You can interchangeably use them. A lot of what we see in the literature is that framework. this is something that is less explored, quite equivalent to the same expansion. So for Uniswap v2, there's no real difference between each one, how you use them. For Uniswap v3, V3 made things a bit more complicated, but it changed that same figure, which was an invariant. Now you can specify a range of prices at which you act. And effectively, this moves the curve down so that it crosses the X and Y axes. And where it crosses is two prices. And this is going to be the price at which your liquidity is going to be acted. And this is something that you have to choose. In V2, you just enter a pool with no choice on your own, and you keep your funds in it. If you do in V3, you have to choose a range, lower price, higher price, and you have to maybe manage this if it goes around outside of that price. Because if the price goes up, you can be 100% holding one token. If the price goes down, maybe you hold the other token. So you have a slightly different end outcome, which is not a mix of the two, but you can be 100% of one token or the other. Yes.
I just want to zoom out a bit here because you said in an earlier slide that LPing is an option to square house, right?
Yes.
Okay, so let's right talk to V2 and V3. So is it still true if it's just V2?
It is still true if it's V2. We're not quite there, but this is V2 or V3.
So if V3 doesn't exist, you would still say the same thing?
Yeah, but it's quite boring. V2 is very, very boring, and there's not much choice, which is what I like with these range. Okay. You can be you can choose it so that you are benefiting most when the price goes up, or you benefit most when the price goes down. You have a lot more freedom, which is where the optionality maybe manifests itself as an advantage compared to V2. But this came out in 2020. This is battle tested. It's been used quite a bit over the past 5 years. And this is how people think about it. You have a range, you just scale this invariant, and the curvature here is higher. You have a effectively higher capital efficiency by choosing a range. You can do, now the formula x times y equals k is a bit more complex. It's cut off, but it's just L squared again. And but you still have this, you have the two range. You can do the same math, but it's, again, a bit more messy. The way that I prefer to see this is, again, in that value over price. And your range is just your price axis, and PA is your lower bound, PB is your upper bound. If you're outside of that range, you're either 100% the asset, so you have a delta 1 type of payoff. If you're on the other side, you have 100% the other asset, which is flat payoff. And the formula in between is square root-ish. It's not that complex to see, but then, yeah, the revision is also straightforward. But the key point is that you have a delta 1 slope here, a delta 0 slope here, and some curvature in the middle. And that's another way I would also think about this as terms of price. I enter in the middle. Does the price go down or up? That tells me about, okay, do I make money or not? And the fees kind of go on top. That's a different way of looking at the two representation of a Uniswap V3 position. Same thing. AMM, X1, Y invariant, or the price over value over price.
So, I mean, there's sort of like two things here. You're sort of talking about the square root-ishness, but I'm also kind of thinking of the hockey stick aspect of it. Like the fact that when you concentrate the liquidity, you kind of get the classical hockey stick, right, whatever, intrinsic payoff of call it. I'm sorry. But how important is the square root? This goes back to the earlier question. Like V2, the entire curvature is just coming.
Yeah. That could be different. It could be a different formula. It could be squares or cubic root. It doesn't matter as much.
When I think about like the vanilla option,
yeah,
it's almost like a hockey stick structure. It's not like it happens to be some kind of like non-linear payoff. It's a very particular non-linear terminal payoff. And so that goes back to like, I get V3 having like a very tight relationship with options. V2 in my head is not an options curiosity, but I guess like
all right. Maybe the concavity is all you need. And let me preface this that you have this payoff. If you shrink the range to a very, very tiny spot, you have two straight lines, which is exactly your payoff of a call option 1 minute from expiry. Yeah. If you widen it, this curvature, there's a second derivative, there's a gamma number. That gamma profile now can correspond to an option that's 7 days from expiring at the money, meaning that you have the same curvature of this.
But
then
not the terminal thing, right? So like So,
Yes.
yeah, but so it's always going to be the exact hockey stick. So
It's as if you have a terminal payoff, which is a 7 DTE. And I would not go, so
you're thinking of the price, like you're the value of the like, so you're not,
yes,
so the terminal value of the hockey stick, you're
yes.
but the point is,
Oh, yeah, you have your
Yeah.
intrinsic value, which is the hockey stick. You have the extrinsic, which is part of that, like Black-Scholes kind of expression, but you have some curvature.
It's hard to think about value when you have to specify an actual model like Black-Scholes is.
Exactly. I did not put this, but you can superimpose the two. You have Black-Scholes expression, you have Uniswap. They kind of match. It's not exact, and then I'm not claiming they're the same. The key point is that if you're very, very narrow, it's an option that is about to expire 5 minutes from expiry, very, very sharp. If you're widening it, making it extremely wide, this is V2 style. It's an express. This is expression that expires in a month, maybe. This is expiring in infinite time in the future, decades, hundreds of years in the future. You have this extremely, extremely broad payoff.
I'm seeing what you're saying intuitively, but not quite like mathematically. Basically, what I'm saying is that look, you can do a very simple thing where you take that sort of terminal payoff, and you're like, look, no matter what sort of option pricing model you choose, it's going to sort of this thing. You can do it specifically and exactly for Black-Scholes. You can do like a stochastic model. Like, so how do you that hockey stick, right?
Yes.
And this square, like the square is
Yep.
So as the game here, we're like, well, it kind of looks like it's having it on the state, but you know, really don't relate it.
Exactly. So the V2, as I said, it's a bit more boring. It is truly taking time to infinity. It expires far from now. So the strike is also infinity. There's a weird thing that happens. If you have a range, you can say this is 95% of what I would expect from an options that is several days from expiring. It's good enough for me because what happens next is that you have a payoff and you have to manage that payoff the same way you would manage an options payoff, which is several days from expiring. And okay, and also just conceptually what happens is that if you add liquidity in a range, this is also something that's going to show you, specify where your liquidity is going to be active. You can convert that payoff to where liquidity is located. And this is a short put like payoff or covered call payoff. You just don't even worry about which model, which stochastic model. This is the intrinsic value of your option. We're not even talking about extrinsic, which normally gives you curvature in normal options. This is just the payoff of this over different prices. And adding liquidity generates a payoff, which is options like. If you're a LP, you have to manage your positions like an options trader almost. You don't have to, you have to use the same tooling, what your data, what Greeks, how you actually manage this. Adding liquidity, you can do this now on Uniswap V3, V4, create these payoffs. You sell an option in a way by providing liquidity and exposing yourself to that type of risk or that type of payoff. When there's a one instrument that exists in finance and economy, you can look at the reverse element, which is what if I short some liquidity? I short an LP token. I borrow a little block of liquidity and I pay it back later. And the key point is that it's going to flip the payoff on the y-axis. You have what was a short put, which is selling a put option. If you borrow a LP token, you create a long put payoff where you have unlimited upside, the same way that the other one had some level, quite high upside, limited downside, whereas it's the exact opposite of what we had before. And we can go through the lifetime of that type of position, but typically you would borrow some liquidity, unwrap its content, and keep the two tokens in your wallet. So if you start with a position that is out of range, you borrow, it's 400 USDC. You keep this in your wallet. Now your debt instrument is that LP position, and what you have to pay back depends on price. If the price goes up, you keep the same, the debt is still USDC, so there's no change. If the price goes down, your debt becomes ETH or a risky asset. And the more the price goes down, the cheaper it is to pay back. So you had 4,000 USDC in your wallet, price goes to 2,500, go in the open market, buy one ETH at 25, pocket the difference between 4,000 and 2,500. You can actually create that exact same benefit of a put option by borrowing someone's LP token. Now you have selling options, buying options, put options mainly, but if you know about put call parity, you can borrow some of the underlying assets. you can go and create short calls, long calls, the whole shebang. So that's what I meant by options clearinghouse. The primitive is still an LP position that lives in this AMM that is doing a service for the traders. But if you repurpose them a little bit, you can create these convex payoff that will generate unlimited upside or unlimited downside by having cost-free custom algorithm. Yes. You can create this position and hold this for years if you want. The key point of this is a option like payoff. And if you keep this train of thought, you said there's no expiry. You can mint something and not have to keep. Yes. So the key point is that this lives not in a vacuum, it lives in a price move. And yes, that position collects fees. And this is the same payoff. We go back to the short put payoff. You start in the middle, price goes up, you make a little bit of money, price goes down, you lose a lot. It's quite asymmetric and maybe a bad deal for most of those users, but you get paid for it. You get compensated by fees. And maybe we can have your second question in case it's related. Yeah.
Yeah, I'm coming from like regular option trading, and I just don't see that you said the value goes basically proportionally to the square root of the price.
Yes. In V2, which is full range or less concentrated.
Some form, because usually you do an average, okay? I mean, it's the other goal.
Yeah. So again, the primitive of an LP position has this option like property, but it's fully collateralized. What I was touching on is that your fees that you collect over time is your options premium, which is start at zero. You sell something, you get zero return. You don't get paid for it. The more you wait, the more you get paid. And if you're out of range, the price leaves your range, you don't get paid anything, which is a bad deal for you, but you are able to collect fees. And if you do this, you say, hey, I held this position for 3 weeks. This looks like a Black-Scholes like payoff. I made 5%. What if Black-Scholes told me what the answer would be? So you can fit an IV to that payoff to say, okay, IV is higher, lower, different than what you have on open markets. But the key distinction is that this is a payoff that is perpetual in nature. Nothing forces you to exercise after 1 day, 7 days, a month. It's perpetual in nature, and the fees start at zero and increase over time. And this is what AMMs and Uniswap gave us. So we just said, okay, if you sell an option, fine, no expiry, fine, no upfront payment. You just collect this at the end. And if you buy an option now, you have maybe unlimited upside. This is actually a pretty good deal for you. You buy something for free, buy convexity without even spending 1 penny. And the more you wait, the more you make. So this one goes up, you would quite get a good payoff. But if you look at the fees collected, what we do is that we say the cost of this option starts at zero. And the longer you hold this, you just match what the fees are. And this is what you have to pay. But because we want to prevent someone from buying all the options, we say there's a tiny spread. You pay a bit more than what the fees are. And this is a market-driven system, and you can pay 5% more, 10% more, or 200% more. And this is how the market will respond. A bit like a lending protocol. Yes, Fahad.
So I'm not totally following, so this might be a little bit of stupid question. So applied call, Black-Scholes applied call, right?
So we don't even, so this is me trying to interpret what the payoff is of that price, but we don't have Black-Scholes, we don't have IV, we don't have any model in the protocol. This is just me saying, all right, let's do this for a while, and what would a Black-Scholes like option give me as in terms of premium? But the real thing is that in Uniswap, it gives you probably a totally different answer because the trades that are happening is giving you a totally different answer too.
I'm trying to understand like the mechanics of your particular protocol, and then understand the payoffs that you are giving.
Yeah.
The profile, the investment profile for the investor who's using your protocol. I'm trying to understand whether there's any embedded assumptions about risk pricing through on
Yeah. So it's parameter free, model free, and this is the key thing. we look at realized volatility, real trades happening in a real pool with real people moving the price around. And if there's a ton of trading that happens naturally,
When you say realized volatility, like I can think about things like using like quadratic variation, but you know, like we're talking about 12-second blocks.
no, yeah. So this is the more fundamental. It's how much it does move. Each move of price pays you a fee. Each move is costly for the traders. So whether you're an arbitrager or a meme coin trader, you pay a fee. And the more it moves, the more it goes back and forth, the more that fee is paid, and the more you turn.
Experience within blocks, for instance.
Yeah. So the Uniswap does all the math. We don't even have to worry about this. But yes, every intra-block, multiple block type of trading, they all have a fee that you collect. And there's an internal tracker that the Uniswap smart contract, we just read it off of it, so we don't even have to worry about the math. But yes. No. Yeah, and also after in the back.
Call it accrued volatility,
Accrued?
like realize the volatility, it's incremental.
Oh.
Fee that you sum, so it's like accrued volatility.
I guess so. Yeah. And then and if you're coming again, sorry, the framing of an Uniswap LP position, this is very, very common for DeFi and crypto native users to understand. The best way I can describe this payoff for a more conventional way is that you have an option that is 7 days from expiring, but every minute you roll it forward by 1 minute. So throughout the day, you push this forward, so it's always 7 days from expiring. And then you always keep doing, it's like 0 DTEs, but now it's 7 days or 25 days or whatnot, but you always push it forward so that 1 minute theta decay, 1 minute change in price is what you pay for that rolling. And that is what is accumulated. So you would imagine that and you can do portfolio constructed this way and get some 7 DTE that moves 1 minute every minute. Or it could be 0 DTE that moves, but it's always 24 hours away. Or it can be 1 minute away, but always never expire. So the best way to consistently see this when you come in from a more options traditional background is that order rolling for, if you're a bank that needs to buy a put option every month, you wait till it expires and then buy it again. So you could imagine you wait 1 day, close it and buy the next 30 days. And then 1 day, it might be 30 days. So the net result is that you have something that goes and grows over time. It's just a delta between now and a minute from now. And the way that we make this a bit fairer is that the price you pay is now a multiplier, a slightly higher number. So you pay on not realized volatility, but rather implied volatility, because you are driving the market. You say, I'm willing to pay 5% more because it turns out that the realized volatility is quite low. So I can actually, yes, I can actually pay a bit more and be happy with that trade. And yeah, in the back.
So when you're selling the call option, are you basing the price daily on the accrued fees that this owner now owes, or how do you do this?
Yeah, so exactly this. We set up that position. We track how much you're owed or how much you should pay. And it's as simple as when you open it, we take a snapshot of the state. When you close it, you say, okay, this all happened, you owe. And I think this is kind of I'll show the actual interface, how it looks like, but this is the TLDR. LP positions are short put options. You can short LP positions, create long options. Fees collected is your options premium. It's a perpetual option, novel instrument. We invented it not because we like it, but because we had to work with that hand that was dealt to us. And again, in the UI, you can create these positions. You can create a put spread, for instance, where you sell an option, buy an option, and it's quite intuitive in terms of what the payoffs look like. You can also preload some strategies where we help people kind of go away, feel bullish, bearish, or neutral. And the last thing is that you can monitor your existing positions. And this is a real position that's been opened. This is a straddle. Someone sold a put and a call at the money-ish when it was minted. We can see how much fees they collected. Big spike here. This is Friday, two weeks ago, where we had a huge crash. You see the theta, instantaneous volatility spike here. And then, but this is exactly the UI, what it shows. You have the fee accrual over time and the payoff. And you know that, okay, if I'm back to this point, I make X. If I go back down, I lose. Yeah.
Maybe you can get there later. How does this look like for a stable coin swap?
Yeah. So this is ETH USDC. It's quite volatile and it moves. We don't have any trading on stablecoin because they don't move as much. It's actually, the IVs could be like 1%. And we have a V2 coming that will make pools work for different types. Like meme coins as well. would be too risky to run on this. So we focus on the blue chips. Yes.
So I understand the analogy you're making between fees and options premium, but there's a critical difference in that the options premium, when you sell an option, is specified upfront and does not depend on the evolution of the stochastic process, whereas the fees do. And in
Yes.
particular, for example, if the fees are arriving from arbitrage trade, like let's say there's only arbitrageurs, the fees will always accrue in a way where your fee is not compensating you for the loss in your option value.
Exactly.
And so how does one think about that? Because
Exactly. So I'll probably have 5 more minutes, but this is the reason why, as a LP, you are giving a bad hand. You are paid on realized volatility. And if there's no organic flow, it's quite low information trading. So you do get paid on realized, and you should be mad about it because your fees aren't high enough to compensate for that convexity risk. So we're looking at
realized versus implied, because even if the realized was the implied, it's a matter that the fees are, you're only earning, like, the fees are correlated with price movements in a way where whenever you earn a fee, you're losing more on the options position.
Yeah, okay. So yes, maybe the best way to think about it is that if the fees are not high enough to compensate because of arbitrage, because of market structure, because of the way it's executed, as an LP, it's not rational to do this. You should not be spending your effort, time, and energy to do something where you don't get paid enough. The flip side, how do you solve this problem? You create an arbitrage opportunity that buys this cheap volatility. You pay on these lower repressed fees. So when you buy convexity, it's going to be cheap for you. You buy something that the IV is much lower. It could be S&P 500 Tesla stocks or that pool. You should be buying what looks like cheap IV. And this is, I'll go through the exercise of a trading. Long straddle, you buy some convexity. And this is gamma scalping, but we can go through that exercise where you have some payoff, delta neutral at the beginning, some positive gamma. And then if the price starts in the middle, no impact. If the price moves up, because you have some convexity, you actually make a profit, right? This is also picking up the more you wait. And the amount of profit you make is, again, quite simply like related to the gamma or the curvature of that pool. But you can do this and earn a fee when there's a price move. Or not earn a fee, but earn some capital appreciation when there's a price move. And after it's moved, you balance your delta, go back to 0. And then now you can do the same thing. If you were to do this back and forth, you have a price move that starts here and ends here. You ratchet your way up. So every tiny little price move, you accumulate a little bit of profits. And even though the price went back to the same price, you do collect these small changes in value. This is gamma scalping. You can do this with options quite easily.
I just forgot.
Okay. So this is what you gain by buying convexity. You can hedge, dynamically hedge, quite simply like the constant hedging, and you can ratchet your way up to the moon, easy money.
I remember, how does the impermanent loss affect the price?
This is the impermanent loss is just gamma risk. If you look at this in reverse, which is selling a straddle, which we had before, impermanent loss is just that, and actually this is the real payoff. It's just how much you lose. It's not magical. It's just your gamma profile, gamma risk that is creating that loss. And the more the price they move, the end state is what secures that loss. But yes.
So to get long, you have to short an LP, which means someone has to give you
Yes.
fee. What do they get?
When you do this as a buyer, you pay them more than the fees they would earn in a vanilla position. And there's $4 billion worth of liquidity in Uniswap, which is sold on realized IV where they don't make money.
Do they accept the price? Do they accept like a asking price for it? How does that price?
No, so it's like a lending protocol utilization. So if you sell 10 ETH worth of options, someone buys 1 ETH, they pay you maybe 5% more. Yeah, if they buy 9 ETH out of 10, they pay you 100% more.
Yeah.
So it's a reactive if you want. The more you buy.
A typical lending call.
Yeah, exactly. So you would reach a target utilization that would give you a fixed premium over realized, which is what you could get. So you do the ratcheting up, you can make money on price moves because you bought convexity. And this is kind of what you do when you do the, it tells them about, this is like gamma scalping return. It's related to the gamma or the curvature of your profile, but also the realized volatility, how much real trades happen, how much the price did move. At the same time, since you're buying now, you pay a fee. and the price did move, but you have to pay back the LP for buying that option. It's also a formula that you can know it's related to this change in the square root of the price. And there's actually a quite easy condition that if the price move is more than twice the fees you have to pay, some pools have a 30 basis point fee or a 5 basis point fee. If it moves 11 basis point, then you're ahead. You pay less than what you make. And if it's within that range, you pay more than what you pay, you lose. So the flip side, that if you're selling, you want to see these tiny, tiny price moves, which is uninformed flow, perhaps that's not arbitrage. That means you get paid more than what you lose. But most of the time, and this is what markets happen, when there's a big move, goes down 15% in a few hours, you could even not rebalance your gamma scalp and make a lot of money because it's one way. There's no back and forth. Whereas if you're selling options, you would need to hedge every time to actually be kind of keep your delta neutrality. So there's a asymmetric management profile where you buy an option, you can be a bit more passive, and it helps you even more than if you're being active. And I'll go quickly because the market structure of the price. This is 3 pools on Uniswap that track the same asset, which is ETH. They all have a different fee tier. They pay 5 bits, 30 bits, or 100 bits. The 5 bits has a lot of back and forth and activity, whereas the 30 bits sees a handful of trades, and the 1% barely sees any trades. Same asset, but because you have to pay a fee, the arbitrage window has to be crossed. So even though the condition is that the price has to move more than the fees, you have the back and forthness of it. That means that the real price you pay is implied volatility base, which is how much you actually pay. And if you do this gamma scalp, this is a well-known formula, which is the variance risk premium. Realized minus implied. You realize is what you see as the price moving. Implied is the price action. And you can think of if there's a sandwich attack in a single block, 3 trades, move the price up, swap, move the price down, you pay 3 times the fee. So the implied is also part of that intra-block activity. You can have 10 trades that net to 0 price move, but you pay 10 trades worth of fees. So that's, again, if you want to run a profitable strategy on a Uniswap pool, buy options and get this type of payoff. If you do some back testing, green is how much you make with gamma scalping. Blue is how much you pay. This is a 30 bits pool. You make a little bit more. So it's actually a good trade. But the key point is that because this is 30 bips, there's a fee below that, 5 bip, that gets a ton more volume, ton more activity. And if you do the same experiment, you gamma scalp a lot more frequently. You are able to kind of capture these 11 basis point as opposed to 31 basis point or 61 basis point. So that is more profitable the smaller the fee tier. Back to this. So a lot of what we want to see is that we're creating perpetual options. You can apply a lot of the same textbook-based strategies to understand this. Hedging, of course, but then also stochastic calculus, but then volatility surface. I didn't touch this, but there's a way to also map out volatility surface from that liquidity distribution. And wrapping up, we're working on Panoptic V2 with better security, better yields, better UX. The last thing that was quite annoying for traders that they did not know how much they would pay or how much they would get paid. There's no upfront payment, which is what people are used to. So we allow this to happen in V2, where you can say, hey, I want to pay this much for that option. And then it makes the risk management a bit easier. I think that's it. So I'll end this here. LP side of AMM is a clearinghouse, is the website. And also, yeah, looking forward to hearing questions.
Thank you.